Hi there, welcome to Commodities. Let's check out the energy complex right now. There's guarded optimism that these nuclear talks between Washington and Tehran will produce some kind of understanding on Iran's nuclear program. Now, Reuters is quoting an Iranian foreign ministry spokesperson as saying that the talks allowed Tehran to gauge how serious Washington is here and did demonstrate some consensus enough to continue on the diplomatic track. So, of course, that could point to lower tension in the Middle East. There is speculation, though, that U.S. President Donald Trump is prepared to send even another carrier to the area to increase the pressure on the Iranian regime. Crude has had quite a move this year. There is a look at a 5-year chart. It doesn't look like much, but crude is up around 11%, both WTI and Brent, the world contract, so far in 2026. There are these concerns about geopolitical flare-ups. This global surplus is hanging over the market, but some observers say a huge glut of oil has yet to show up in the statistics. And let's check in on where the metals are trading. We saw some selling in base metals today, and you can see gold pretty flat, down about 0.5%, way down from the 5,500 record high it hit more than a week ago. Copper and aluminum down, although copper's not far off record highs. A big Chinese holiday is nearing. There had been buying in advance of that, but there's anticipation that Chinese purchases will slow down over the next while. And benchmark copper in London slipping towards $13,000 US a ton. But you can see that copper is trading in record territory in anticipation of huge demand for that huge global electricity build-out. Prior to this, copper was up about 2% or more over 2 sessions. So we have that Chinese Lunar New Year coming up, and that starts next week. And here's a sign of the times. French exports of wine and spirits have dropped to their lowest volume in at least 20 years. Trade tensions and weak demand eating into revenues. Sales by value have actually been falling since 2022. The big problems, China and the US. Beijing imposed anti-dumping measures on European brandy, while the Trump administration put import tariffs on France. And here are some other commodity-related stories we're watching. Vizsla Silver declining yet again on the TSX, down only about 0.5%, but that stock's been in free fall. The Mexican authorities say at least 5 workers from its Mexican project were found dead. 10 people were actually abducted from that site in Sinaloa State last month. And 5 other bodies have been found, and they're trying to identify the individuals. Import delays are halting output at some sugar refineries at Indonesia. According to Bloomberg, at least 2 sugar refineries have been forced to stop production due to delays in getting permits from the government. Stockpiles of raw sugar ran out in December. Indonesia is a massive importer of sugar, the world's 2nd biggest. And the shutdowns are raising concerns that the domestic food industry won't be able to get enough supplies. Prairie Sky Royalty is increasing its dividend by 2%. TD calls this company, which collects cash from oil and gas companies operating on acreage in its portfolio, an asset base, quote, that replenishes itself or grows, with nearly $2 billion worth of capital spent on its lands in 2025. We are joined by the president and CEO, Andrew Phillips. Andrew, thanks very much for coming on the show.
Good afternoon. Thanks for having me, Andrew.
Just give us a breakdown, roughly, if you can, between oil and natural gas production on your lands, please, in percentage terms.
Yeah, oil and liquids make up about 63% of our production by volume. The remainder is natural gas, but that oil and liquids portfolio generates about 93% of our revenue right now, just given the weak gas pricing.
And I know at least one analyst was encouraged to see that your liquids or your oil and liquids production were up lately.
Yeah, we've actually had almost 4 years now of consecutive organic liquids growth. So it's been a big positive, just given some of the capital efficiencies of the great producers on our lands. We've been fortunate to see them continue to grow, and therefore we continue to grow.
Maybe we'll put up a 5-year chart for the US, the Henry Hub natural gas contract. Well, your pricing, though, for natural gas is mostly off AECO, the Alberta contract?
It is, yeah. So we get paid 45% AECO monthly, 45% daily, and then 10% of our gas goes through Sumas. So for the most part, we collect our royalties on the AECO pricing and the AECO benchmark, which has been subdued over the last few years.
That's frustrating, isn't it? We keep hearing talk about massive natural gas demand to fuel electricity generation, but prices still depressed.
Yeah, it's been a challenging sector for sure for the last 5 years. 2022 was a bright spot for sure. I think we have some of the best producers in North America operating in our basin and some of the lowest cost gas resources. So ultimately, we will find a way to get better value for our gas and get the molecules to market. And
quite a bit of your acreage in the Duvernay formation?
Correct, yeah. Some of our fastest growing acreage is in what we call the West Shale Duvernay. There was a significant discovery made there over the last few years, and it's been expanded to the point where now it's starting to get to full development mode. So that's been a bright spot for us from a production standpoint.
Just looking at your stock over 5 years, you have lagged XEG, the energy producing ETF. Now, obviously, you can say, well, you know, we sink in zero capital. We're more predictable that way. We don't run that particular risk. But why would you have lagged over 5 years?
Yeah, it's a good question. I think ultimately, just given we have 98% operating margins, zero capital costs, and a strong return profile to shareholders, I think it should ultimately do better than the XEG, as most of the mining royalty companies outperform the bullion over time. So I think in the fullness of time, we should outperform those, but there's definitely more operational leverage on some of those names that are within the XEG, which kind of pulls them up a little bit in sometimes when people are looking for exposure. But I think over the long term, we should be able to outperform that, I would believe.
And of course, that XEG is dominated by the giant oil sands stocks that have really won the hearts of investors lately.
Correct. Yeah. And those are wonderful businesses. They're long duration businesses with low declines, and they make up the biggest part of that index. And they're very, very good companies. So we're fortunate to have them in our country, and we're fortunate to have a few of them as large royalty payers.
Your payout ratio is something like 70%. Would you increase it, or why wouldn't you go to nearly 100% if you have zero capital cost?
Yeah, we can take a lot of the free cash flow and invest in the business. We believe the intrinsic value is somewhere in the range of $50 to $60 per share for our business. So we believe we're buying dollars for 50 cents when we cancel shares. We canceled 2.6% of the shares outstanding last year. We're also able to do $100 million of M&A in the mid-teens last year. So with that kind of return profile, some of the capital creates a better business if you can redeploy it in those two ways.
Sorry, you've been buying back stock. And what was the other thing, buying land or buying rights to land?
Yeah, there are certain royalty packages available. We bought a $50 million package last year that was the Petro-Canada fee that dates way back to the early 1900s. And that's an asset that we think we can achieve mid-teens or higher return at $57 crude. So a great opportunity to redeploy some capital in high return projects. That's always our preference if they're available. But because we own over 70% of Canada's fee, those opportunities are less and less.
And can you remind me, have you gone into the States at all? Have you looked at buying acreage down there or buying rights down there?
No, we stick exclusively to Canada. We're the largest in Canada, and I think we do look at the U.S. auctions and some of the where some of those royalties trade, and they seem to, for less high quality assets, they seem to trade to lower discount rates. So we just find Canada's what we know, and that's what we understand. So we just stick to our knitting.
Andrew, we better jump. Thank you very much indeed for joining us.
Appreciate having me.
Andrew Phillips, President and CEO at Prairie Sky Royalty. Okay, oil patch advisors are anticipating continuing takeover activity. We saw plenty of deals over the past 2 years. There is pessimism over oil that we could be facing a surplus in the early part of this year. Although oil has bounced back a little bit, more than 10% this year. We'll have more on that after the break. Our guest prefers owning companies focused on natural gas. He cites increasing energy demand for AI data centers and a possible further weakness in oil prices. We're joined by Darryl McCubry, Vice President and Senior Analyst at Veritas. Great to see you as ever, Darryl. Thanks very much for joining us.
Good afternoon, and thanks for having me, Andrew.
Start off just with this theme, though, of possible more mergers in the oil patch. We have seen a bunch of takeovers, as we have in gold, of course. Do you think that's going to be a factor in the market this year among Canadian energy companies, M&A?
I think if the kind of widespread concern concerning like quarterly consistent supply build or stock build in global liquids markets, if that plays out and the feared kind of trajectory down towards a $50 per barrel WTI kind of environment, I think then you could see some urgency perhaps amongst some players. But on the whole, I still think the real focus here is shareholder returns still. And there's an apprehension, I think, to use the balance sheet to supplement shareholder returns. So I might fear that the reception of an M&A, an aggressive M&A policy, could be looked down upon, even if it's mostly debt funded, meaning the cost of capital is relatively low.
Right. Shareholders might think, well, okay, you've got a nice big company, maybe you get a bigger paycheck for more you oversee more production, but what's in it for me?
That's exactly it. I mean, the sentiment is pretty clear that direct returns through the base dividend, special dividends, and buybacks is what's appealing to the energy investors currently.
What right now, and we're looking at some of the points, you do say that there's a cloud over the anticipated stockpile build in oil, and you're less enthusiastic about liquids. Gas generally is meeting your needs right now, partly because of the anticipated electricity growth?
Yeah, I mean, broadly, globally, transition is kind of defined, the decarbonization by electrification, mostly premised upon wind and solar, winning a lot of market share within electricity markets. AI is just one component of that. There's the EV theme as well. There's potential displacement of kind of direct distributed natural gas with electric heaters. But foundationally, I think the idea is that if it's going to be an electrification theme, there's a bit of a kind of high watermark maybe on some of the resource constrained technologies like solar and wind, to the extent that once they get to maybe a quarter of a grid supply, they're going to be bumping up against the reserve margin of those grids or the available capacity in the event that the resource constrained tech isn't available to produce. And so I think that's why you're seeing more of a focus on baseload in general. And then, of course, the kind of 24/7 secure data or power needs of data centers, that also supports more baseload energy. And so the competition really isn't between like wind and solar versus natural gas. The competition is more in the capacity resource market, where natural gas will compete against nuclear. Natural gas might compete against utility scale batteries. And in those arenas, natural gas holds a pretty significant cost advantage currently. And so if electrification is the way and affordability is still a core concern globally, natural gas is an appealing bridge fuel. And so I'd say my preference for gas stocks over liquids isn't so much just AI specifically. It's the cost advantage of natural gas as a bridge fuel to potentially displace solid fuels like coal and liquid fuels like fuel oil that we still use quite a bit of in some regions of North America still.
Just getting on to stocks that you favor right now, Imperial Oil's had an incredible run. I mean, despite a relatively weak oil price, these oil sands giants have thrived. You have a sell on Imperial right now.
Yeah, so there's a couple elements I think at play there. The market, I think, is already looking forward to a worst case where you could see benchmark WTI trend towards US 50 per barrel. In those scenarios, Imperial holds up relatively well. We were assuming a base case price of about US 60, so just a shade below where it is today. So that's one element. The other is, of course, the Exxon ownership, the very low cost of debt, even though they don't use a lot of debt. Having that low cost of debt theoretically should keep their cost of equity pretty low. And also, of course, the risk premiums should be lower because of their integration that provides the defense at lower WTI prices. And so all of those elements, I think, have caused a bid up on valuation for Imperial.
Major's a little expensive for your taste.
Well, I think of Imperial as kind of already being owned by maybe the best special interest purchaser it could possibly be owned by. And so that's not necessarily a negative thing, but it is something to contemplate when comparing relative value against competitors who don't currently have that advantage. Because maybe one day a special purpose purchaser comes in and takes out the likes of some of the other oil sands players that don't have an Exxon at their back yet. And maybe they could unlock synergies across the cash flow statement elements.
Thank you very much, Darryl. We better leave it there. Great hearing from you. Darryl McCoubrey, VP and Senior Analyst at Veritas Investment Research. Up next, shares in BP down more than 6%. The company is halting sharebacks, making it pretty well unique among the energy giants. We'll hear more on the disappointment over BP today when we come back. BP, the British-based energy giant, says it's suspending its share buyback program. As part of a strategic shift, it plans to use the money to bolster cash flow and invest in new oil and gas opportunities. This is almost heresy among the big oil companies. Chevron, ExxonMobil, and Shell have continued to buy back significant amounts of shares. Lower oil prices, of course, have been eating into their profits lately. Let's get more from Rob Thummel, Senior Portfolio Manager at Tortoise Capital. Rob, thanks very much for joining us. I mean, this is, you could say, a gutsy move by BP. Investors have become accustomed to these share buybacks.
They sure have in the oil and gas space, and you're right, Andrew. That's one of the great things about the energy sector is it generates a lot of free cash flow. Early on, a lot of the energy companies actually generated a lot of free cash flows and reduced their debt. BP did not do that as much, and so now BP has a stated goal of reducing their debt. And as a result of that, they are now going to have to stop buying back shares because they need to take the free cash flow that they have and not buy back shares, but reduce debt. And so stocks trading down a little bit today as a result of that, and probably will continue to trade down until BP gets its debt level down to where it's wanting it to be.
And the backdrop here, of course, is that BP, under the previous CEO, Bernard Looney, made huge investments in renewable energy, and they're backing away from that now.
Yeah, that's exactly right. BP took a little bit of a different course than the other majors like Exxon and Chevron. Exxon and Chevron actually were pretty acquisitive and bought some oil properties in the Permian Basin in particular during the low oil price environment, and that's starting to pay off for them for both of those companies in terms of the cash flow coming back to shareholders. BP went the other route, as you mentioned. They went down more of a renewable energy route. The returns just didn't seem to be there, so now BP's in the process of still generating free cash flow, but it's going to have to use some of that free cash flow to reduce their debt.
Would you be a buyer of BP now? Do you think that investors have digested the disappointment is in the stock already?
Well, what I'd say, Tortoise, we look for some of the highest quality companies and highest quality managers of those oil and gas assets. We're not a buyer of BP right now. Obviously, the stock does trade at a discount to Exxon and Chevron. But if you just look at the project inventory for Exxon and Chevron and even other larger oil and natural gas producers, we see better opportunities within the other major oil and gas operators as well, rather than at BP.
Wow, I'm just looking at a 5-year comparison here for BP and Exxon, Chevron, and Shell. Exxon has just been on fire lately. Certainly, if we can put up a 5-year chart for XOM, it's been shooting up.
Yeah, well, I think what investors have, broadly speaking, I think Exxon benefits from maybe a bit of a rotation. Obviously, big cap tech was popular or has been a great investment. what Exxon and the whole energy sector does, and Exxon's leader of the pack there is generate free cash flow, and that's what investors have been looking for. And so they've been rotating to a certain extent into energy, get free cash flow, to get an increase in yields, dividend yields. If you're looking for a dividend yield, the energy sector is a great place to be.
And Exxon, of course, known for its stubbornness. There's the wrong way and the Exxon way, and they just have they have proceeded really, as you say, with buying up hydrocarbon properties and not investing as significantly in renewables.
Yeah, no, that's been their goal. They've done a good job of allocating capital. Frankly, they've done a fantastic job of generating free cash flow, managing manage the business when there was a downturn. You know, this is not the first time that they've had to manage through a low commodity price environment. So the team at Exxon has done a phenomenal job, set themselves up, for the future pretty well. They've still got carbon capture business that they actually acquired from Denbury and the infrastructure associated with carbon capture. So that's really important as well. Exxon's doing some things looking at rare earths in the Smackover field, basically in northern Arkansas. I mean, that's an opportunity as well. So there's just a lot going on. Of course, Guyana was the big thing as well. Obviously, Guyana is a major oil and gas, major oil find for Exxon as well, and that will pay dividends literally to shareholders into the future.
Could BP has its own major oil find off Brazil. Could that ignite the stock? Do we still have to hear more about how rich that discovery is?
Yeah, I think so. I mean, there's a lot of oil fields out there now, and gas fields, obviously. BP's has Brazil. They talk a lot about what's going on in the Gulf of Mexico. Mm-hmm. There's a lot going on in Guyana. Now we've got Venezuela. And BP won't probably be involved in Venezuela. So that might be a catalyst for the stock. But I'll be honest, I think getting their debt down to a more manageable level, like BP is doing, is probably a good opportunity here. This is kind of the standard. Look, a new CEO is going to come in, clear the decks. As far as capital allocation, and will allow her to decide what course and direction she wants to take with the business, mm-hmm. and it's clearly she wants to get started off with a better balance sheet.
Thanks very much indeed for joining us. Always great hearing from you, Rob. Rob Thummel, Senior Portfolio Manager at Tortoise Capital. We are at a time on commodities. Thank you very much for watching, and we've got the close of Mirella Fernandez coming up next.